Investing has traditionally been a boring way for anyone and everyone to accrue wealth over a given period of time. When you think of investing, you probably think of Warren Buffett straight away. But what happens when we see a huge influx of new investors, more than have ever been seen before, hit the markets full of enthusiasm, excitement, and optimism in a time where the future of many businesses were looking grim? To understand how 2020 really changed the stock market completely, we need to take a little trip back in time, going all the way back to the 1300s. Yes, all the way back to the Merchants of Venice. I know I'm not speaking about the William Shakespeare play, but the actual Merchants of Venice. Venetian moneylenders who sold debt issues to other lenders and individual investors. These lenders were even purchasing government debt issues at the time, the first documented time we've seen people trading government securities. In the 1400s, Belgium then became the centre of international trade. People would buy and sell goods to one another in anticipation of their prices rising or falling, ultimately to make profit. Sure, they didn't have investment brokers, they didn't have fancy apps like we have today, but it was essentially the same premises. In 1611, the first real case of stock market investing, as we know it today, was created in Amsterdam. LLCs were first formed around this time too. It was nothing compared to what we know today. In fact, there was only one company with trading activity for many years, the Dutch East India Company. They would set out on voyages funded by investors and return the profits in the form of dividends, the exact same way that it's done today. In today's day and age, investors may like a company such as Apple and invest in their company to fund their next voyage, aka the next iPhone. The hope is that funding this next venture will ultimately lead to a return seen as profits or dividends. The markets just gradually became more and more sophisticated as the decades and centuries went on. In 1790, the Philadelphia Stock Exchange is formed, which catapulted the development of investing in the US's financial sectors. Only 2 years later, the New York Stock Exchange was founded. In 1896, the Dow Jones Industrial Average is created. A couple of decades later, the S&P 500, not quite as we know it today, was created. And then only a couple of seconds later, you hit the juicy like button on this video to help your boy out. Now some more modern history for all of you guys. 1929, the US stock market, as we know it, sees its first major crash. Black Monday, the 19th of October 1987, the S&P 500 and the Dow Jones both drop over 20% in a single day. The dot-com bubble, where once again we've seen what greed and hype does to emerging markets and eager investors. Financial crisis of 2008, and finally, we're brought to 2020, okay? Where in February, the S&P 500 had dropped as much as 34% in the span of about a month. As someone who began their investing journey as this crash was happening at the age of 22, I can tell you how exciting it felt. Investing isn't something that has traditionally been seen as exciting. We look towards Warren Buffett, Charlie Munger, Benjamin Graham, Peter Lynch, all of the greats. They're all very calm and composed individuals. We're told to invest in index funds, the S&P 500, slowly but steadily, and to expect maybe a 10% or so average annualized return over the next 40 years. It's not sexy, it's not exciting, but it's worked for longer than most of us have been alive. What is sexy and what is exciting, to many people at least, is trading and also is gambling. It's getting 100% returns in a day. It's the promise of 100 times gains on the next big thing. The problem is when people begin to confuse gambling and investing. The essential difference between betting in fluctuations and anticipating inevitable advances and declines is the essential difference between gambling and speculating. The differences may be subtle, but they are extraordinarily important. 2020 and 2021 truly were the years of the retail investor. It's clear to see when we look at some of the stats from Robinhood, the most popular broker for retail. Their users went from 10 million in 2019 all the way to 22.5 million in 2021, and you can now see a considerable drop-off in 2022 as euphoria dies off, as stocks start to go down, as cryptos start to go down, as it becomes harder to make consistent money. It's important to keep in mind that these people we see dropping off are retail investors, the everyday person like you or me. The average Robinhood account has a size of about $3,500, which is literal pocket change compared to competitors and pennies compared to big money. But retail flock to markets in hope of a fast V-shaped recovery in a post-runny world, which is exactly what happened. But it did not last forever. Retail wasn't investing their money into dividend kings and index funds. They weren't starting to invest in this period of time because they thought now was the time they needed to chase 10% annualized returns, or else they would have started investing a long time ago. Airlines and cruise lines had to completely stop operation for months and months. The TSA checkpoint numbers showed just how dire the situation was, and still to this day the numbers often aren't back to where they were even in 2019. So people decided this wasn't going to last forever and expected sharp rebounds, and they were right. If you were lucky enough to buy American Airlines on May 11th and hold it for less than 3 weeks, you could have made 181% returns. That is huge. If you bought and held Carnival Cruise Corp for a couple of months, you could have made 216% if you got a little bit lucky too. Anyone remember our good old friend Nat, aka Nordic American Tankers? Same thing goes there. At the time it was incredible, like genuinely incredible. People were making so much money as long as they were selling and taking some profits along the way. To a lot of people, these were their first experiences with stocks, and that created a skewed vision of what investing really is. These returns are far from normal under normal circumstances, but weren't at the time, and that is so important to remember. People didn't know it at the time, but these returns would ruin long-term investing for them. Again, look at the Robinhood numbers. The adrenaline became more important than the fundamentals, and modest gains seemed like a loss to most. There were many more crazes. SPACs, for example. You could throw money at literally any SPAC, and most of the time, you would easily see a 100% return. A lot of these, right now, are well below their SPAC price, but the point still stands. Electric vehicles. If you bought early, you were doing fantastic, but a lot of people bought in when they were already up 400 and 500%, when the perfect situation was already drawn out in their 2 to 3 year time lapse, and they've lost a lot of their initial investments. Fundamentals became a second thought for a while, as every single ticker symbol you threw money at would go up, and it truly seemed like it could last forever. People began to flock to biopharma stocks, as some of these companies could move hundreds, if not thousands of percentages in a matter of minutes. These people weren't investing. Oftentimes, they didn't even know what the company did. They didn't know why the company could go up in value. They just saw that it might. And again, this worked incredibly well until it didn't. If we look at the chart of the S&P 500, it doesn't even look all that bad. But remember, as we said earlier, this isn't where retail was investing. Growth stocks, technology stocks, recovery stocks, all got hammered to the ground. All you need to do is look at any given ARK ETF. These were the king of retail investors for a very long time there, to see a more accurate representation of the average retailer's portfolio. Not only did people go from making hundreds of percent returns on a regular basis, but they began to lose money fast. You all know the saying, the house always wins. And when you're gambling in the stock market, the saying still stands true. You can get lucky for a while, but if you are gambling and not investing, you will lose eventually. There is a built-in edge. 2020 showed us what can happen when the government bails you out via quantitative easing and inflation control, when world leaders work together, and when things begin to look better. 2021 showed us that for every action, there is an equal and opposite reaction, and that these things cannot last forever, no matter how much we would like them to. And 2022 is showing us right now that things aren't always as quick to fix themselves as they were in 2020. If there is a lesson to be taken from any of this, it's that the most well-known names are well-known for a reason. They don't let the hype affect their emotions. They have their convictions, and they stick with them, whether for better or worse in regards to money made or lost. They follow a set of rules, and regardless of whether they're having a good or a bad day, they're having problems at work or at home, regardless of how they feel, they stick to that set of rules. Warren Buffett has said in the past, "We sell really when we think we're reevaluating the economic characteristics of the business. We probably had one view of the long-term competitive advantage of the company at the time we bought it, and we may have modified that. That doesn't mean that we think the company is going into some disastrous period or anything like that. We think McDonald's has a fine future. We think Disney has a fine future. And there are others, but we don't think their competitive advantage is as strong as we thought it was when we initially made the decision." He and his team don't just sell companies based on them doing well, doing poorly, based on fear, or what other people are saying. And on the contrary, they also don't buy because of those reasons. I want to leave you all with a quote that sums up a large portion of 2020, and one that, as a YouTuber, it may be difficult to share, as it could lead to less people viewing our videos in general. "Nobody can make big money betting on what someone else tells him to do. So keep that in mind next time you go and try to blindly follow someone. They could lead you to a pot of gold or right off of a cliff. YouTube is an amazing place to get different opinions on everything in the stock market, but ultimately you need to be able to form your own thoughts and opinions if you want to be a successful investor. I appreciate you guys tuning in to watch this video. I hope that you are all doing okay physically and mentally. I hope that you are taking care of yourself. I really do appreciate you watching. If you enjoyed the video, please do hit that like button. Drop me a comment down below. Let me know some feedback for the video. I know it's a little bit of a different style. And please, my friend, if you are new around here, subscribe for more content coming soon. Anyway, guys, I hope you all have a beautiful, blessed day. I'll see you for another video very soon. Peace.